Welcome to Second Take, the show that focuses on the issues behind the news. The government of Ghana is collaborating with South African gold mining company Gold Fields by providing fiscal relief to keep its mines going in the country where there is no weaker currency respite. Martin Creamer joins me to discuss the matter further. Hi Martin.
Hi Tracy.
What prompted the government of Ghana to implement this relief?
You know, it's a very interesting pragmatism from this government. The collaboration is very interesting because, you know, at the back of it you're saving probably 2,000 jobs, but you're not just mentioning the jobs, you're actually engaging with the South African investor. So a South African investor in Ghana has managed to get an interesting, unique collaboration with the government. Now we know many of the mines in South Africa are in serious trouble. I mean, some of these platinum mines going into pay talks now, they are in serious trouble because the dollar price of platinum hasn't lifted. We have had a lift with the dollar price of gold, but just look at that in Ghana, where a South African company, Gold Fields, is exposed directly to the dollar price. It hasn't got the benefit of the rand price that we have here, which suddenly when you look at the rand price, the gold price in rands has soared. The gold price in dollars has lifted a little bit. But even with that little bit, they were probably going to have to close the mine in Ghana. They're probably going to have to close that Damang mine. Because even in the third quarter presentation to journalists, Gold Fields was saying, we've really got to take a strong look at this mine because, you know, to capitalize it against the background of not getting a proper return on the gold price means that probably our timing is out. So we could close that, and you know it's got direct employees of 1,000 employees, indirect of another 1,000. But we see pragmatism and some sagacity by the government. They are saying let's be competitive, even though you don't have the benefit of a weaker currency here. Let's try and be competitive. So you know, cutting 2.5% off the corporate tax rate immediately, you know, on St. Patrick's Day, as it was, and then saying from the very first day of January, we will give you a new royalty regime instead of the flat 5% on revenue. Remember, that 5%, that royalty charge is on revenue. Whether you make a profit or not, you still pay. We will rather turn that to 3%, depending on where the gold price is, but at this point it would be an effect of about 3%, rising to 3.5% once the gold price rises, and then only going to 5%, you know, once the gold price is beyond at $2,300 an ounce and beyond. Interesting, the way the Ghana government tackled this. You know, we've had a lot of angst between government and business here. We've had a lot of talks. They normally just beat a drum around the jobs that are going to be lost. But you know, this is saving jobs, but at the same time making the country competitive for an investor which wants to keep on investing. And they'll probably now invest quite heavily in the central portion of the Damang mine, where they got to remove a lot of overburden in order to get to a central core of high-grade gold, which is needed to save that operation. I think it maybe, you know, our own Minister of Mineral Resources could take a look at this and just see how other countries are making sure that they don't lose investors, that they are pragmatic, and that they also exercise some wisdom because they know that the contribution to the economy of these gold mines is substantial.
Could you discuss the specifics of the fiscal relief that's being provided?
Yes, you know, that tax relief, it is a reduction of something like 2.5 percentage points. So maybe they were a little bit high, I think at about 35%, and other countries are more in the region of 30%. But they acknowledged that with a cut. You don't often get that from a government that's saying to you, suddenly for you, we will cut the corporate tax rate by 2.5%. Then with royalties are particularly punitive because whether you make a profit or a loss, they don't care. They just look at your revenue and they say, we want 5% on that revenue. That was the flat rate that was charged. They've seen that that is non-competitive. So the big thing around looking after your investors is being competitive. So governments have got to be competitive. In this country, we're saved by the weak rand. In that country, the miners are fully exposed to that dollar price of gold. And you can see that that dollar price isn't adequate. So they've decided to ensure that the revenue level that dictates what they get from a royalty is lowered by 2%, which is substantial, and that it'll only build up when the gold price builds up, which is also wise. You can see that even in our coal mining industry, they've been saying, can't the government and business collaborate a bit when the price is down? Can Transnet, when it's transporting the coal, can't it just look at that and lower its tariff and have a sliding tariff so that when it's up, you're going to get the benefit, but your country doesn't suffer when things are down by people not being able to export at a profit because the tariff on the state-owned rail is too high. Give us a sliding scale. And we know that was done with the aluminium industry in South Africa, where they gave a sliding scale. Now we find that the Ghanaian government also giving a sliding scale on the royalty, so that when things are down, they tighten their belt and they get less. When things return to normal and even build up, they get extra amounts going forward. And then of course they did stick at that 5%, because 5% on revenue can be substantial, particularly if things are going well. Just it impressed me that they want to collaborate, they want to talk, because there is this realization that investors in mining are very important, because they bring in foreign exchange. As they export out of your country, they're bringing foreign exchange into your country, which is so important. The other thing is they're bringing foreign investment in, which is absolutely key. And because they've made this adjustment, I'm sure that a recapitalization of that Damang mine is now on the cards, because that was the study. Now, do we recapitalize this or do we close this? One or the other. I think that they realized that they would have to close it. And the government has come and said, look, how can we make sure it remains open? Not only do we keep those 2,000 jobs, but we also get that foreign exchange. We also get the foreign investment. Now, I think that's something that our Mineral Resources Minister needs to look at. They are very narrow and they just say jobs. You can also do other things that keep your jobs and also keep the revenue coming in, which is so important for our rand. We need foreign exchange coming in. And we also, if someone's going to spend 100 million, as could be the case now with Goldfields, just allow them to spend that, because overall you're going to win.
And how has the corporate tax cut and the reduced duties been received by Goldfields? Well,
they are saying, look, we commend the government of Ghana for making sure that they do things fairly and competitively. So they have played open cards, clearly, with the government, and the government has seen that they're slightly uncompetitive, and they have been prepared to come in, and they've been commended now by South Africa's Goldfields, which is a significant investor in that country, and saying, look, you have come into line competitively, you're competitive now, and this is also fair, what you're doing is fair. So I think that's a nice sort of comment on government collaborative action. And coming out of Ghana, it is a pleasant surprise on the upside for me.
You mentioned that Damang is currently being reviewed, but what are the current states of these projects, Damang and Tarkwa?
Yeah, so Damang has been a problem child. They mentioned it in the third quarter, they reiterated it in the fourth quarter. Damang we've got to do something about, because it's high value in spots and low volume, but perhaps the price of the gold in dollars was going to shortchange it. So it was heading for care and maintenance. That was in my mind. Damang was heading for care and maintenance. Tarkwa is a much bigger mine. It's a big, strong mine, and that under these circumstances now has also been given a boost. So it's a sort of a collective boost of these two mines, which are the main mines that Goldfields has in West Africa and Ghana. And we see down the road, in the same country, we've got Anglo Gold Ashanti with Obuasi, also a problem child. So perhaps some sort of arrangement now will come that is similar to what we've seen to the other South African investor, Goldfields, perhaps the Anglo Gold Ashanti, might also get some sort of collaborative treatment, because we see there that there is a problem with illegal mining. And what the head of Anglo Gold Ashanti has done is he said, look, let us acknowledge that people need to have some sort of access to mine themselves. These alluvial miners have been doing this for centuries. Now, why do we need to cut them off totally when we've got such a big concession? So they've said, look, let's give to the alluvial miners, or the illegal miners, or whatever you want to call them, 60% of that concession, and we will concentrate on the 40% where we're mining. Pragmatism, again, from the corporate side, saying, let's do a deal here. We know that Randgold Resources were offered half of Obuasi. We're saying, you come in and fix this, you get half ownership. And they ran away. They said, so it's going to be a difficult mine, so I'm sure there's going to be collaboration there as well. In the meantime, we see this collaboration coming through in the case of Damang and Tarkwa. It's put a smile on the face of the South African investor Goldfields, and I'm sure their shareholders. And maybe we'll see more smiles as they do more collaborative deals. And it's an example to us in South Africa of the need to study certain investments and realize that this is for the common economic good. So don't start just harping narrowly on these things and bludgeoning people over the head. Let's really study this from a government point of view and see what can be done for the good of the country.
Thanks, Martin.
It's a great pleasure, Tracy.
That's it for today. Join us again next week for more news analysis on the mining industry.